Hello, everyone. Welcome, and thank you so much for attending today's webinar on tax reform and energy. And we'll be discussing the provisions in the One Big Beautiful Bill Act and next steps on implementation. I'm Lynn Abramson, president of the Clean Energy Business Network, which is co-hosting this event along with our parent organization, the Business Council for Sustainable Energy. This webinar is being recorded, and we will distribute the recording and slides to all registrants. You can ask questions at any time via the chat, and we will go over them midway through the event and then at the end. So our agenda today is we're going to start with a brief welcome from myself and Lisa Jacobson, the president of the Business Council for Sustainable Energy, and also discuss the energy credit provisions in what we're calling OB3 for short. I've heard that term thrown around a few times and I like it. And Andy Barnes, CEBN's Director of Policy and Communications, will be covering some of those provisions. We're also thrilled to be joined by two terrific guest speakers. Avi Zevin, who is partner at Roselle LLP, will be discussing the foreign entity of concern requirements in the legislation. And then last but not least, we'll have Lynn Mushensky-Keck, partner at Witham, who will be discussing the Section 174 R&D deduction and the small business retroactive carve-out. So first, just a quick introduction to the Clean Energy Business Network. We are a nationwide nonprofit organization that serves as the small business voice for the clean energy economy. Our network spans more than 8,200 business and community leaders working across all 50 states, more than 400 congressional districts, and a broad spectrum of energy technologies and services. I'm going to turn it over to Lisa to introduce the BCSE.
Thank you so much, Lynn. And it's wonderful to be here with all of you today. Really important topic. We're still just a few weeks out from the enactment of the One Big Beautiful Bill Act, or OB3, as Lynn is calling it, and there's a lot to unpack. So I'm really looking forward to hearing from our guest speakers today, and of course from Andy Barnes with Clean Energy Business Network. The Business Council for Sustainable Energy is a broad-based energy trade association. We were formed in the early 1990s to bring together the companies and associations that represent energy efficiency and clean energy resources. Those span energy efficiency, natural gas, renewable energy, sustainable transportation, and many new emerging technology areas. You can see our membership right here. We are all focused on realizing a competitive and thriving U.S. economy, and we believe that needs to be underpinned by a strong, resilient, affordable, and clean energy system. The tax credits have been decades-long investment drivers, really bringing the public sector and private sector together to modernize and expand our energy resources and to ensure that new and sustainable energy has a place in our energy landscape. There are many changes that you'll hear about today that impact many different energy sectors. The Business Council for Sustainable Energy and Clean Energy Business Network were extremely active over many decades to help improve and sustain those credits, and in recent months, very active in educating and advocating for maintaining those credits and making them workable for the business community. In some areas, we saw some pretty good improvements from original proposals to enactment, but in other areas, we really saw some pretty damaging developments, in particular when it relates to energy efficiency credits or the residential credits for clean energy, solar and storage in particular. For other sectors, we have very short transition timelines to new rules, and in some cases, we're awaiting what the rules of the road will be. So you're tuned in at the right time. This is going to be extremely important information for all of you, and I am really glad that BCSE is partnering with Clean Energy Business Network to put this webinar together. So back to you, Lynn.
Terrific. Thank you so much, Lisa. So I'm just going to start with a very quick overview of OB3 and then turn it over to Andy to start going through the energy provisions in more depth. So just to set the stage first, starting around late February, Congress began working on a major tax reform proposal, and this was with the goal of implementing President Trump's priorities for permanently extending many of the tax provisions in the Tax Cuts and Jobs Act of 2017. We saw several iterations of this proposal move through committees and floor consideration in both the House and Senate. And then President Trump signed the One Big Beautiful Bill Act into law on July 4th. So, as Lisa mentioned, it was really a mixed bag in terms of the final outcome of the legislation. We did see a number of improvements over the course of consideration, and I do think that hearing from energy business voices was critical to securing some of those changes. But unfortunately, some industries were hard hit. The final legislation leaves some industries relatively untouched and unscathed, but does rapidly eliminate a number of credits for efficiency, residential solar, and electric vehicles. And it also abruptly phases out wind and solar. Andy's going to talk a lot more about these provisions in a moment. One very bright spot, something we have been working on at CEBN for years now, is the full and permanent restoration of the Section 174 R&D tax deduction with retroactive tax relief for small businesses. And as I mentioned, one of our guest speakers is going to discuss that further at the end of the webinar. We have a link here and we'll be sharing this in the chat as well as in the follow-up slides. Please visit our tax package resource center for a detailed overview and a summary table. And now I'm thrilled to welcome Andy Barnes, CEBN's Director of Policy and Communications, to provide an overview of the energy tax credits in the legislation.
Thank you, Lynn. I'm going to walk through a few tables summarizing the major timelines for tax credits, looking at OB3, so the newly enacted law, versus previous timelines under the IRA. And I want to flag we've grouped these into a few buckets. So you can see in the top right corner of your screen, we have a little key. So we have rapid elimination, condensed timelines, untouched tax credits, as well as extended tax credits. So for this slide, these are largely consumer-facing credits. They are all facing rapid elimination within a year under OB3. EV credits definitely face the harshest timeline, being largely phased out by the end of September this year. Credits for residential energy efficiency and clean energy, so that's 25C and D, would both be eliminated at the end of this year. Then we have new energy efficient homes, so 45L, EV charging infrastructure, 30C, and commercial energy efficient buildings, so that would be 179D. All three of those expiring June 30th next year. So shifting to the tech neutral tax credits, folks may recall that the Inflation Reduction Act created a new tech neutral tax credit regime. So the ITC 48E and the PTC 45Y. And under this tax credit regime, solar, wind, geothermal, hydropower, battery storage, nuclear, and waste energy recovery all had automatic qualification. And then future zero emission technologies were able to be added should the Secretary of Energy deem them eligible. So under OB3, the newly enacted law, wind and solar, unfortunately, have separate treatment from the other tech neutral technologies. So they're facing much shorter timelines here. Wind and solar projects that commence construction before July 4th next year, so that's 1 year after the date of enactment, retain the current safe harbor provisions to claim the credit. So that means projects must be placed in service within 4 years to qualify for the credit. Now, projects that start construction after this time frame must be placed in service by the end of 2027 to claim the credit. And in addition to this, OB3 also prohibits the use of Section 48 for wind and solar lease financing. And then just a note on the other technologies. So some of those that I mentioned off the top, geothermal, battery storage, hydropower, these maintain the full value of the credits through 2033 with a short phase out by 2036. Let's see. So in addition to that, I did want to mention the bill also includes a slight language modification for the waste heat to power industry, clarifying life cycle emission calculations for eligible projects prior to date of enactment. And then I also did want to mention that transferability would be preserved across the credits. One quick note on the safe harbor, so you'll hear about this more shortly. The IRS is currently formulating guidance related to beginning of construction, and this is likely to come out within the next 3 weeks, probably around August 21st. So stay tuned on that front. So shifting to our final set of credits, the other 45 and 48 credits, starting with the hydrogen PTC. So this is 45V. This was significantly reduced with the credit expiring at the end of 2027 rather than in 2032. Geothermal heat, so under 48A, this is the lone technology left from the original Section 48 tax credit. It retains eligibility through 2034 under OB3. Nuclear and carbon capture largely retained their existing schedules with phase outs in 2033 and 2032, respectively. And then shifting to advanced manufacturing, the phase down schedule was preserved for some technologies such as battery and solar components. However, wind was dramatically shortened. So with the credit now only available for wind manufacturing to goods sold through the end of 2027. Critical minerals, I wanted to note it previously had a permanent credit for the advanced manufacturing tax credit. It will now be phased down from 2030 to the end of 2033. And finally, the loan sort of extension, clean fuels. So that's going to be Section 45Z. This was given a modest extension over the IRA. So under the IRA, the deadline was 2027. It now terminates under OB3 at the end of 2029. So that is a short summary of the new tax credit timelines. Next, I'm going to turn it back over to Lynn to talk about the executive order.
Thank you so much, Andy. Really appreciate that overview. And I just want to remind our participants, I've seen at least one question come in on the chat, but you can type your questions at any time and we'll go over them at the end. So the executive order that was signed by President Trump on July 7th is titled Ending Market Distorting Subsidies for Unreliable Foreign-Controlled Energy Sources. My colleague Nadia will paste that in the chat. And this is partially with respect to implementation of the energy tax credit provisions in OB3. So the EO directs the Treasury Department within 45 days, so that should come up around August 21st, to take all action deemed necessary and appropriate to enforce the termination of the tech-neutral tax credits for wind and solar, and to implement the FEOC provisions. So we have one key section of the EO in this little call-out box here. I'm not going to read the entire thing, but basically it's saying enforce beginning of construction, don't make sure that the policies are not circumvented. And it also says, and make sure there's no sort of effort to manipulate eligibility, and also calls for restricting the use of broad safe harbors unless a substantial portion of a subject facility has been built. So there has been quite a lot of speculation in the energy community about what this will look like. What does this mean? Really, no one knows except for the Trump administration, but we should know sometime within the next month. Under current IRS guidance, a project can qualify in two ways for beginning construction. One is either by meeting a physical work test where they have begun construction work of a significant nature. And the other option is a 5% safe harbor, which is triggered when the taxpayer has incurred 5% of the total cost of the energy property. And keynote for commence construction, you have to make continuous efforts to advance towards completion. So it's not just, here's my down payment, now I'm going to do nothing. You have to demonstrate, and I heard a great webinar last week talking about having photos, receipts, a lot of documentation. It's unclear whether Treasury will open up those rules. They are regulations, they are rules, they are not in law. We have heard some speculation that they may consider shortening the time frame for projects being placed in service to meet that place in service requirement, or they may consider imposing more stringent requirements. This remains to be seen. It's also entirely possible that they just may be more stringent in enforcement. In the current rules, there are some options to make the case for an exception if the project developer fails to meet some of the requirements. If you can really demonstrate we made good faith effort, but fell short. But we do suspect that this administration will be very strict in interpretation, so keep that in mind. And one other note, the EO further directs the Department of Interior to examine and revise any policies that provide preferential treatment to wind and solar facilities in comparison to dispatchable energy sources. And we did a couple of days ago see some materials released by the Department of Interior on this subject. And one of the new things we've been seeing is secretary level sign off and approval on projects. So that's something to keep in mind if you are working on public lands. Again, under the 45-day deadline, we anticipate the guidance from Treasury coming out around August 21st or so. Hopefully it is not delayed, as I know many folks are anxious to have that information. And as soon as implementation guidance is available, CEBN will continue to provide updates. So with that, I am very excited to welcome our first guest speaker, Avi Zevin, who is partner at Roselle LLP. And previously, Avi served as special assistant to the president for clean energy implementation, and that was under the Biden administration. So he's very familiar with a lot of these issues, and he has been closely analyzing the FEOC provisions in OB3 and will explain the requirements and timelines for us. So thank you for joining us, Avi.
Well, thank you, Lynn, and to the CEBN and BCSE teams, and to all of you for being here. As Lynn said, I've been tasked with giving you a high-level overview of the what are often called the Foreign Entity of Concern or FEOC provisions in OBBB or HR1 or OB3. Lots of options there. The language in the statute is actually to call these prohibited foreign entity restrictions. The term foreign entity of concern largely does not show up. That's been the shorthand for some time though now. So I probably will use prohibited foreign entity and FEOC interchangeably, but you should know that I mean them interchangeably. Before diving into the details here, I think just as a bit of framing, one important sort of overall picture to take away here is that the rules that were enacted related to these foreign sourcing and foreign ownership and foreign influence related restrictions are highly complex. They take up, numerous pages of legislative text and involve overlapping and nested definitions, many of which are not, not knowable exactly how Treasury will implement them just on the face of those statutory provisions. And they provide many explicit callouts for Treasury to issue guidance and clarification. And I suspect we will get that, though not imminently. And so these are highly complex issues. I'm going to only really be able to provide you a high-level overview here. And of course, I am not your tax lawyer. So I think my intention here is to provide you with enough information to be able to talk to your tax lawyer about the right and smart questions to be asking, rather than that you would sort of come away from this presentation knowing, all of the nitty-gritty details of exactly how it's all going to work, in part because none of us know exactly how it's all going to work. We're going to have to wait for some Treasury direction and guidance. With that said, though, let's dive into the details and then happy to answer questions. So the FEOC restrictions really apply across tax credits to different and varying degrees. In this useful graphic from the Bipartisan Policy Center, there's sort of an accounting of each of the different types of prohibited foreign entity restrictions and which tax credits these different types of restrictions apply to. Don't worry, I'll go through what each of these types of restrictions are as we go. But I think the high level takeaway here is that for credits like the clean fuels credit, the carbon capture credit, the existing nuclear credit, there are some restrictions really largely related to the taxpayer themselves and whether they have a too high a degree of control or influence from certain adversarial countries like China, Russia, North Korea, and Iran. And for the advanced manufacturing tax credits, the 45X tax credits, as well as the technology neutral clean electricity tax credits. That's the 45Y production tax credit and 48E investment tax credit. There are a lot of additional requirements really related to contracting and supply chain sourcing that also apply. So different sort of configurations of requirements that apply differently depending on which tax credit you're interested in. Let's go to the next slide. At a high level, the sort of most direct and widely applicable set of restrictions relates to what the law defines as specified foreign entities. And so generally, any taxpayer that wants to claim a credit cannot themselves be a specified foreign entity. And the specified foreign entity definition really flows into many of the other definitions that then become nested restrictions. So these are sort of important foundational concepts to understand. And a specified foreign entity is sort of the most direct control by one of these covered nations, of which China is, of course, the most substantively and politically substantial in both concern and likely coverage. And so specified foreign entities are entities on certain national security lists, like sanctions lists or lists of Chinese military companies. They're also the actual government of a covered nation or a instrumentality of that covered nation, like China. Any citizen or national of one of those countries, other than citizens or nationals that are US citizens or lawful permanent residents as well. Any entity or business unit that's incorporated or organized under the laws of or has its principal place of business in one of these covered nations like China. And any entity that is, quote, controlled by such entities. And control here has a very specific definition looking to the Internal Revenue Code, Section 318A2. And that is basically any entity owning a greater than a 50% vote or value share of a subsidiary that subsidiary would be controlled by that parent company or parent entity. And that's really related to these corporate type entities. Though, of course, you can have control by an individual citizen. So if you had a sort of citizen that was a non-US citizen of China that had greater than 50% ownership of a US LLC, that US LLC would be a specified foreign entity. The rules here related to who counts as sort of controlling are really these sort of what's called upward attribution in the tax code. These are the parent entities, the parent companies. So if you have a sort of a sibling company, two different companies owned by the same parent, that sibling company is not going to infect the US entity. Similarly, if you have a sort of literal familiar relationship, your father or grandfather or sibling or daughter, that would not itself infect the relationship or the specified foreign entity relationship here. That is a change from what was more stringent rules in the original House proposal, which is part of why I'm highlighting it. You might have heard about these sort of completely unworkable familiar relationships, and that was scaled back and clarified some in what finally passed. So this universe of entities are specified foreign entities, and like I said, really under any of the tax credits, any taxpayer that is themselves a specified foreign entity would not be eligible for credits, and then these entities feed into the other restrictive definitions. So let's go to the next slide. The next sort of concentric circle of breadth and restriction is what's called foreign influenced entities. And here, these are entities that have some sort of relationship with a specified foreign entity. So not directly with the government of a covered nation like China, but with one of these specified foreign entities. And so if a specified foreign entity has the right to directly, not indirectly, but directly appoint a covered officer like a board member or a member of the C-suite of a company, that company that for which the specified foreign entity has that right would also be considered a foreign influenced entity, which is a type of prohibited foreign entity that is not eligible for tax credits. Similarly, if there is ownership of 25% or more by a single specified foreign entity or 40% or more by a mix of specified foreign entities, that too would lead that subsidiary to be a foreign influenced entity. There are restrictions on debt issued to specified foreign entities, and there will need to be some clarifying guidance about exactly what it means for debt to be issued to a specified foreign entity. Generally, that appears to not restrict debt held later by a specified foreign entity if that debt was acquired but not directly issued to a specified foreign entity. That said, this is an area where I do suspect we'll see some guidance from Treasury. And then there's something called the effective control payments test, which I'll cover in more detail in the next slide. And that test is really only applicable to the technology neutral tax credits and the advanced manufacturing tax credit. So not like the nuclear credit, the fuels credit, the carbon capture credit. There's some limited compliance streamlining for publicly traded entities in terms of how you determine, what entities you have to look at when you're looking at ownership or debt issuance. Though I will say the level of simplification and clarification there is not substantial. Generally, the same types of rules apply with some additional clarity for publicly traded entities, not to have to go down to the literally every single human being who owns a share of stock. So that's an area that for you to be aware of, that's sort of complex and worth talking to tax counsel about. Let's go to the next slide. So one form of being a foreign influence entity, but one with additional complexity and only applying to those credits I said before, is entities for which a payment has been made, where that payment confers what the code calls effective control. And that's basically a payment between the taxpayer and a specified foreign entity directly. There's some complexity around related parties here. I won't get into the details of that, but I think the archetypal example you should think about is you are a US taxpayer with no Chinese ownership, but you make a payment to a, let's say, Chinese subsidiary that's wholly owned by a Chinese headquartered company. That would potentially be a problematic payment, depending on what kind of payment it was. And there's really two types of payments that you have to watch out for here. One is a contract that confers effective control to that specified foreign entity over the production. So if the Chinese subsidiary is able to determine the amount of solar module production being made at your US facility and you're the US taxpayer, you US taxpayer would be making a prohibited payment and you would be deemed a foreign influenced entity that would not be eligible for the credit. So what counts as effective control is somewhat complicated. There is a list of types of contractual provisions like control over the amount of production, the timing of production, who gets to buy the product that you're making, that are listed in statute. But then this is one area where the code is provides a lot of discretion to Treasury to sort of replace or augment the existing set of contractual provisions that one needs to be concerned with a sort of expanded or different set at Treasury's discretion. So we'll have to see what guidance looks like here. The second type of payment that can be an issue is a payment for IP-related costs or licenses. And there, while there's lots of complexity, the sort of simplest way to think about it, again, talk to your tax lawyers, is that any agreement that confers that for which you are purchasing an IP license from a specified foreign entity that is entered into or modified after enactment of the bill, so July 4th, 2025, would be a problem. In addition, certain more limited set of IP arrangements entered into even before the enactment of the bill could be a problem. And for this test, if you are if you have a prohibited payment, the taxpayer would be deemed a foreign influenced entity for all of the projects that they have, even if that payment was only with respect to one project, for at least the year following that payment. And so they would not be eligible for a credit, either the production credit, tax credit, or the investment tax credit for that year. There are also some broad authorities for Treasury to adopt anti-circumvention rules to prevent circumvention of the intent of these rules, and we'll have to see what those look like. And then importantly, for the 48E technology neutral investment tax credit, there is a very broad and potentially disruptive recapture provision, such that for 10 years after you claim the ITC, if a prohibited payment is made to a specified foreign entity, in that 10-year period, you would be at risk of having that ITC recaptured up to 10 years later. And so there's quite a long tail there. Now there are some complex restrictions on when that actually applies, and again, that has to be a payment directly to an SFE. So it's not sort of any payment to anyone, but that is a potentially complicating area that may drive some taxpayers to the production tax credit rather than the investment tax credit, which doesn't carry this particular recapture rule. Let's go to the next slide. All right, and then the last category is what is called material assistance. Material assistance is effectively a set of requirements about whether you have sourced too much of your supply chain from a foreign influenced entity or a specified foreign entity. And here it applies to either of the previous two categories. And how much of your supply chain can you source from one of these entities? Well, that's a complicated question. It varies by which technology you are producing, electricity or one of the supply chain components in 45X. And it also varies over time. And the way to think about it is, and the sort of tests are here on the slide. I'm not going to the text is small and I'm not going to read it all or go into the details. There's some useful guidance from, or charts from Bipartisan Policy Center. And I have a list of resources here at the end of the slide deck as well. But the basics is you need more than a certain percentage, a certain threshold percentage of, quote, good content, that is content sourced not from one of these prohibited foreign entities, in order to be eligible for the credit. And if your percentage exceeds that, you're going to be in trouble in terms of being able to claim the credit. And that amount of good stuff rises over time from roughly 40%, for example, for the electricity credits in 2026, up to 60% for those that are at least continue to be eligible for the credits into the 2030s. And the Treasury has until the end of the year to provide guidance, and these restrictions don't really kick in until the end of the year, and specifically, they don't kick in for projects that begin construction prior to the end of the year. And so there's a lot of questions to be resolved around which exact components and which exact costs have to be taken into account. The law provides in the interim, until there is guidance, some direction about what the drafters intended, including that you're supposed to look at the direct costs to the taxpayers, but also there seems to be some indication that Congress intended to look at the sort of main manufactured products incorporated into a facility for the electricity credits, or the main materials incorporated into a production of something for the advanced credits, but then also maybe the components, or at least one level down from that. But there is some ambiguity there. And then a lot of discretion for Treasury to implement this in a particular way and issue safe harbors. There's also a reference to the domestic content bonus safe harbors, which provide a set of components and assumed costs that one can use. And there is an intention that those are usable, those sort of provided costs that are already provided for wind and solar and batteries, but not for other technologies, can be used at least until Treasury issues new guidance. So, but then Treasury does have the discretion to fully replace those existing safe harbors if it wants to. It also includes some provisions for supplier certification options and penalties if suppliers or taxpayers falsely certify, and again, wide discretion and the ability for Treasury to issue anti-circumvention rules. So a lot of uncertainty here still to come, and this is probably the area of the most complexity, and happy to answer more questions. If you go to the next slide, I'll just say there are a number of resources of good explainers that you can take a look at from NYU's Tax Law Center, from the Bipartisan Policy Center, Norton Rose Fulbright, which is a law firm with a large tax practice. Lots of other firms have one. I just thought this was a particularly sort of easy to digest one. And then, of course, my firm, Roselle LLP, please feel free to reach out if you're interested in talking about these issues. So that's all I have, but happy to answer questions when we get to that point.
Well, thank you so much, Avi. I know this is extraordinarily complex. We have a number of great questions in the chat. We'll get to as many as we can at the end of this webinar. I think we clearly need 3 or 4 more webinars because there's so much to unpack. I want to clarify, I mentioned earlier the 45-day guidance that was required from Treasury. And just to reconcile that with what Avi said, the FIOC provisions, we're not expecting detailed guidance in 45 days. We probably will have a little bit more of a clue on the commence construction requirements. But as Avi noted, these FIOC provisions kick in at the end of the year, and that's when we should know more. And so finally, I would like to welcome Lynn Musensky-Keck, who is partner at Witham. She has over 20 years of experience in accounting and federal tax policy, including positions at a Big Four accounting firm and overseeing the European region for a Fortune 500 company. I will say she has just been a terrific partner to us in navigating Section 174 and advocating for its restoration over the past few years. So she's going to explain the Section 174 R&D provisions in OB3, including the small business carve out and a number of other related types of topics. So Lynn, over to you.
Thank you so much, Lynn. So when you obviously saw what's happening and what happened with the One Big Beautiful Bill, many people are excited because it essentially allows a permanent reinstatement for domestic, not foreign, domestic research and experimental expenditures that were paid or incurred in taxable years beginning after December 31st of 2024, where many people are spending time and scratching their heads are, well, what does that mean for all the previous expenditures, domestic expenditures that I capitalized in 2022, 23, and 24? Before we get too far into this, I'm going to, similar to a consistent theme you've heard throughout today, the IRS does need to issue additional guidance on this. There is a kind of contradiction in what we're seeing throughout the law, but also in direction of a method of accounting change. So while I'm going to talk to you about what we're seeing and how we're interpreting now, we are, I would specifically say the AICPA's Tax Policy Committee is issuing a letter to the IRS this week asking for that guidance to be provided. And we'll talk about why we're asking for that guidance to be provided by the latest of September 1st of this year, mainly because it's impacting 2024 tax returns that might not have been filed yet. So this is going to get complicated, but bear with me. And the other item I would like to point out is don't be too quick to jump on essentially saying, I'm going to go back and take all the deductions in previous years, or I'm going to take them all in 2025 or 26. We'll talk about that in a second. You really need to do a modeling exercise here. As many of you know, when you create a net operating loss for your company, that net operating loss can only offset 80% of your taxable income in the following year. So ideally, what we're doing is we're matching the deductions in the year that the revenue is being created, so there is no such limitation. That is going to be a challenge, right? Because we have a variety of things going on top of 174. For example, we have bonus depreciation, right, back in effect for assets acquired after January 19th of 2025. And there they say you can take 100% bonus depreciation on those assets, or you can elect to continue to just take 40%, or you can go down to your regular maker's depreciation. So there's 3 different levels in that alone. In addition, we have a change in our interest expense limitation rules. So now all of a sudden, before you might have been limited on not being able to deduct all your interest, but because now we're allowed to add depreciation and amortization back, you now might have a ton of interest that you can deduct. And therefore, you may not want to go forward and deduct all your 174 previously capitalized assets in 2025. You might want to split it between 2025 and 2026. More importantly for me is for people who want to go back and retroactively, if they fall under the exception, can amend their 22, 23, and 24 returns. Be careful about 382 limitations. So remember, if you push a large loss into these years of 22, 23, and 24 because you went back and amended, but now you have an ownership shift, you'd be limiting those losses on a go-forward basis. So if those are other items that you need to be considering, along with excess business loss limitation rules, et cetera, et cetera. So you can see that we can't really keep this change and adjustment on a one-way track. There's so many interactions from the various other parts of the bill that modeling is required. But I'm going to jump in and we're going to talk about on the next slide, essentially things that we are going to first talk about what happens in 2025. So in 2025, there are options. So you don't have to immediately deduct, and many startup businesses may choose not to immediately deduct their 174 domestic R&E or 174A now domestic R&E because they know that they're not going to be producing the revenue associated with that until future years. So yes, you could in 2025 now just immediately deduct your domestic R&E, but there also are two other options. So the one option says you can make an election on your timely filed 2025 tax return and essentially say that you want to spread that expense over 60 months. What I like to point out here is it's 60 months from the time in which you first realize the benefit. So it's not as if I'm saying, okay, divide by 60, and now I'm going to put a portion on 25, 26, 27. I don't start that 60-month reign until I first realize the benefit, which they generally say is when it becomes an income producing item. So that's your second option. Your third option, which we deal with a lot, especially in the pharmaceutical industry, is they'll say, well, I don't necessarily want to wait until I first realize the benefit, but I do want to spread it over a long period of time, knowing that the revenue stream will not be as significant in the earlier years as later years. So that's when there's an election to actually take your domestic R&E and take it over a 10-year period. So many options that are considered for 2025 and going forward. But now let's talk about, well, what happens to all those domestic R&E uncapitalized expenditures that are sitting on my books for tax purposes at the end of 2024? Next slide, please. Okay, so here we have a beautiful exception, but this exception only applies to small businesses. If you've been in the tax code, your advisor should be well aware of what a small business exemption is. It falls under Code Section 448C. We've had a look at it for methods of accounting, 263 Cap A, a variety of different reasons. And so here, what they're essentially saying is, we want you to look at your 2024, 2023, and 2022 gross receipts average over those 3 years. And we want you to essentially determine, on average, did they exceed $31 million or were they less? If they're less, you can be considered a small business exemption. And these two options are available to you. I always have to remind people that determination of your gross receipts test is done on an aggregated basis, meaning if you have brother sister companies or parent subsidiary companies, you can't just look at the company that generated the domestic R&E. So it can become complicated in that way. In addition, I always like to remind people that a variety of things are included in your gross receipts, even potentially interest and dividends, to the extent that they're an item that you're receiving while conducting an alternative trade or business. So definitely take some time and make sure that indeed this exception applies to you. If this exception applies to you, you have two options. The first option is to say, I'm going to make what they call an election, and I'm going to go back to the 2022 taxable year, and I'm going to file amendments for 2022, 2023, and 2024 to immediately allow that deduction to drop to the bottom line. Many of us, especially I know working with Andy, like that because we had such a huge cash outlay in 2022 and 2023 when we received a variety of grants and had to use them all within 1 year, but essentially were trapped to having to amortize these expenses over 5 years. Here's the complication. The first, there's different interpretations floating out there, which is why additional IRS guidance is needed to go back to 2022 and 2023 and amend. But now you're sitting in 2024 and you don't want to write another check. And do I really have to file it and then amend it to make an election? I mean, based on the current existing wording, it does appear that way, that they're saying, no, you have to file if we follow the law to the T. And so many people have been advocating with the IRS and the AICPA. We've been being vocal and saying, you can't what an administrative burden with no purpose, right? And so can we please be told that we're going to be allowed to immediately deduct the 2024 domestic R&E on the originally filed return and not have to do an amendment? So that's something we're waiting for guidance on that we need to follow. In addition, I would point out that this election has to be made by July 4th of 2026, essentially. It has to be made within 1 year of the date that it was enacted. So don't sit on your hands, right? And say, well, I'll figure that out later. And also you're balancing within that statute of limitations when you can go back and amend. So all things should be taken into account. In a deed, they do say you're able to adjust your 280C election if you go back and amend within the first year when doing these types of amendments. Alternatively, you can say, I don't want to go back and do that. Maybe I have some 382 limitations that I'm worried about and I want to push the NOLs forward. So essentially, then I can choose and elect to say, I'm going to take all of that uncapitalized R&E and I'm going to essentially immediately deduct it in the 2025 taxable year, or you can immediately deduct it and spread it over 2025 and 2026. And those decisions that when and how you're going to deduct it are interlooped with those other provisions we talked about previously. For those of you sitting there and say, well, maybe I don't want to immediately expense my uncapitalized R&E. Maybe I'm comfortable with it just remaining, right? That balance as of 12/31/2024, just completing its 5-year projection. And that's okay too. These options for small businesses are elections, right? So you can elect. But it doesn't mean you have to, so that you do still have the ability to say, I don't want to do anything with whatever it needs to be capitalized. I'm going to let it follow suit. Obviously, in 2025, you do have to make decisions, but you can allow 2024, 23, and 22 uncapitalized amounts to keep running and be capitalized over the 5-year term. I will point out that with the 2025 immediate expensing or immediate expensing in 25 and 26, it will be a change in method of accounting. So we're also waiting on IRS guidance regarding that. How will it be a change in method of accounting? Can we attach a statement as opposed to a 3115 like we did previously? Do we know a DCN number, et cetera, et cetera? So we are waiting for that additional information. Next slide. And then lastly, if you're sitting there and say, I know I clearly am not a small business, you really are limited to one or to two choices. You can either say, I guess I should say three. You can say, I'm just going to continue the amortization in 24, 23, and 2022. I'm not going to do any elections. I'm good. You're going to elect to immediately expense everything in 2025. And then, or you're going to elect to spread the deduction over 2025 and 2026. Some people have asked the question, and this will be really technical, but if you're in an interest expense limitation, you will understand about if I make this election in 2025, is that an add back for purposes of my 163J interest expense limitation? Meaning, can I take that and add it back to form my EBITDA before I get limited for interest expense? And it tends to be that a lot of people are becoming comfortable with that position, even though if you read the actual bill, it just says you're allowed a deduction. It doesn't refer to the fact that you're allowed an amortization deduction. So I just threw a lot at you. I'll bring it back up high level. This is good news for domestic R&E. Foreign R&E, not so great news, right? Continue over 15 years. And they clarified items of what will be treated on, how that will be calculated if you should sell your asset, your foreign R&E asset. So they really tightened foreign R&E, and that will remain under 174. 175A, very good answers for domestic R&E, but now we're just waiting on clarification to the IRS how to properly take those and essentially receive our refunds if we choose to do so, or accelerate future tax benefit in the future. So again, we are hopeful that AICPA, it's unclear right now if the IRS is going to meet the 9/1 deadline, and we need that 9/1 deadline because we'll be going to be filing tax returns on 9/15 and 10/15 for the 2024 year, extended tax returns. And it's unclear at this point whether or not the IRS will provide guidance by that time. So this is something you should be monitoring closely. And speaking with your tax advisors with. Happy to answer questions, or feel free to reach out separately through an email, and I can assist you as we move forward. Passing it back to Lynn now.
Lynn, I think you might be muted.
That was great. Okay, let's try that again. So here is our staff contact information should you have any questions for our team and want to get in touch. And now I'm going to ask you, maybe Andy, to stop showing the slides so we can just ask a few questions quickly to go over things that were already covered in the chat. Some questions on the safe harbor rules. I think we discussed that after that question was asked with respect to the EO. Question about power purchase agreements by nonprofits. That should be okay if it's in terms of direct pay. A question about geothermal heat. Is that geothermal heat pumps? And I clarified that that's under a different credit, section 48A, which was untouched by this legislation. So now that we've dispensed of that, we have a few questions relating to commence construction. And I welcome anyone to help me with attempt to address these. A question about project with 45 stores. It's a special purpose entity. It started in September 2025 with continuous construction. How long to get it done? My understanding, if I understand this question correctly, is that there's no impact on projects that have already started construction before. Is this correct?
So I think what are the and Avi, correct me if I'm wrong, but I think under essentially what they're saying under the notice or under the IRS bill is you can rely on notices for the start of construction. Start of construction will be deemed to occur the earlier of when you've paid 5% of expenses or when you essentially have had substantial amount of construction. So when you think about that, don't think about engineering or think about shovels in the ground and moving construction. I think where the discussion comes up is the continuous requirement. And the continuity requirement, it's an OR test still. So if you're there's a safe harbor that says if you complete your project within 4 years of the year you started construction. So if I start construction in 25, that would be 26, 27, 28, 29. I would need to complete it. Then I'm automatically deemed to have met the continuous safe harbor requirements. Alternatively, though, if I don't meet that date, you do just have to be able to reflect and document that you have been continuously working on the project consistently, right? And not something where you maybe put 5% down and then tried to start the project, hadn't done anything for 2 years and then started it in year 3 and then butted up against that deadline. But that's how I think that's the clarifying question, but I'll put it to Avi to confirm.
Yeah, Lynn's description of the current set of guidance is right on. I think the real wild cards are to what degree do things change and to what degree do things change prospectively versus retroactively with new guidance that is sort of the subject of this executive order. With respect to material assistance, the supply chain requirements and whether you've begun construction for figuring out whether you need to understand what your supply chain is, the law actually codified the existing set of guidance that Lynn just walked through. The way that got codified, it's sort of like ambiguous about what the scope of types of things that applies to. Is it every commenced construction sort of question, or is it only with respect to this FEOC compliance? And we're going to have to see what Treasury sort of says in its forthcoming action that Lynn previewed in response to the executive order Lynn Abramson previewed in response to the executive order in mid-August. Treasury uniquely has some pretty broad authority to issue retroactive rules and guidance, but that would be a very big step to take. So, I can't guarantee to you here on this call that they won't try and do something pretty aggressive given some of the political rhetoric going on, but the normal course, like far and away, and the legally safest course for Treasury would be to, if it makes any changes to the set of requirements that Lynn Musensky-Keck walked through, would be prospective for entities that have sort of met those requirements after the date of issuance of that guidance, or 60 or 90 days after that. So,
Can I ask a
for this
question,
particular
Avi?
example, I think it will depend a little on what happens.
And I would ask you, I've always wondered, can the executive order override the bill if they provided guidance?
No, certainly a fundamental provision of
Right.
or sort of concept of law is that statutes trump agency discretion if they are clear, and the executive order is really, the way to think about that is it's not itself law, it's just sort of directing Treasury how it can and should exercise its own discretion under law. I think the problem is there is some ambiguity about exactly what got codified and what it applies to in terms of the existing guidance for commenced construction. And that's where there's some play in the joints and some potential litigation that entities will have to sort of drag the courts into sorting out if the administration decides to take an aggressive position.
Great, thank you. And a couple other questions kind of on this topic and that I'll quickly review and then go on to other topics that were raised. A question about if you've begun BLM applications, NEPA, does that, I think the implication is, does that start as commence construction? And my belief is no. I would encourage folks to look at the current IRS guidance, but let's see what's released. It's a little bit more stringent than that. Question about 25D for before December 31st, 2025. The expenditures, if you've made the expenditures, but you haven't gotten the utility permission, are you okay? My understanding is generally yes. If you've made the expenditures, but just haven't been interconnected.
Yeah, can I jump in on that one,
Yes, please do.
Lynn? Like, this is an interesting and I think somewhat ambiguous question. The statute says expenditures, but then it sort of goes on to define expenditures as meaning constructed, which is different than commenced construction, but it's also different than placed in service. And whether one has to have interconnected to the utility to have met a constructed standard is, I think, untested, at least to my knowledge. But it's possible there are some private letter rulings that I'm not aware of, etc. But right, like the statute, and there is no specific guidance on this question. So certainly you can't just have like signed a contract. You will need to have like built the thing. But whether you've needed to have taken that last step of getting a utility interconnection, I think is not clear at this point, to me at least.
Great for thank you for clarifying that. We do have a number of questions. I kind of grouped these for Lynn. Just did OB3 touch depreciation? There was also a question about MACRS, the Modified Accelerated Cost Recovery System. Any implications for those provisions?
Yeah, so they absolutely did. So for the what we call 100% or bonus depreciation, it's determined not based on a place in service date, but is determined on really a binding written contract date, and it's linked to President Trump's inauguration date, which we're all kind of like, couldn't we just have had a clean cutoff? But the answer was no. So I would say if you're doing any major purchases or in binding written contracts, that's when you need to go back and review those. If it's clearly circling around that January 19th date. So anything after that January 19th date, binding written contract or placed in service or otherwise, would be susceptible to the 100% bonus depreciation. 100% bonus depreciation, currently it's supposed to be 40%. So 100% bonus depreciation generally is for 15-year property and below. Another big item, though, that went into the bill was real property immediate expensing as well. It's called qualified production property. And the qualified production property is if you're building, if you're building a production property or if you're acquiring a piece of property to use it for production facilities. And it hasn't been used for production facilities in the last, I forget off the top of my head, 5 years or something similar. And so essentially you can immediately take 100% deduction on the real property related to the production facilities. So that's a big potential, huge win for people who are in that space. Makers is always still there. You could elect out of bonus depreciation. And I would just say, the one thing I always say to people, it's not an all or nothing test. Pull your triggers. Like you could elect out for your 5-year property, not your 7, et cetera, et cetera. So there's planning to be had there as well. And then always remember, which if you have interest expense limitations, that add back of depreciation and amortization before assessing that limitation is a big win for people who may have been stressed in the past with their interest expense deduction.
Terrific. Thank you so much for that, Lynn. A couple of questions relating to the FEOC provisions that Avi covered. I think we may have already touched on this, but what is the definition of appointing a covered officer? And let's start there. Do you want to elaborate on that, Avi?
There's not a statutory definition. It has to be direct authority to determine the officer. I don't have a more concrete answer than that. It is, I can't just to be candid, I have like not done a deep dive into whether existing tax law principles would apply here in a useful way. So they may well, but the statute itself and existing like energy tax guidance does not clarify that question.
Okay. Question about how does FIAC play with Chinese manufactured solar panels? And you covered the timelines, the percentages. Anything to elaborate on that?
No, I mean, if you're a project developer using Chinese manufactured panels, um, you either need to have lower than 40% of your total system costs be from those starting in 2026 or begin construction before 2026.
Okay.
Yeah, and I would just also add that there's a significant impact, obviously, in solar, but also battery. We're seeing a lot of adjustments having to be made to battery modules and cell manufacturers.
Yeah, and there is some language around anti-circumvention there in which I think there's some uncertainty about whether Treasury is going to try and address the sort of currently stockpiled panels. I don't know where they will land on that.
Kind of related, do you have any insights, Avi, on how to document the percentages in material assistance cost ratios?
So there's a certification procedure for your suppliers that's, I mean, a certification option that's sort of got some complexity in the code. So that's like one option if you need to go down that path. The simpler option, if you have it available, to use is to use the safe harbor tables, which sort of like specify percentages of each component type, in which case, if you use those, you don't need to know what your actual costs or percentages are of your own particular facility. That's the benefit of those. And I know in the context of domestic content bonus and otherwise, it can sometimes be hard to get detailed cost estimates from your suppliers who see that as a competitive business issue to provide you, particularly of their, like further down the supply chain or up the supply chain, I guess. So the safest will be that. In terms of like what paperwork is going to be required, there's not currently a revenue procedure on this, so I think we don't know in detail, but I would suspect it is roughly around, the same types of books and records that one needs to keep for demonstrating compliance with general tax purposes for the like as to like which things you bought. If you do ultimately need to like know exactly what costs are from your suppliers, that's where the certification procedures in this law would apply, at least until there's guidance. And those are complex, probably don't have time to get into them, but there is some detail provided.
Okay. And I'm going to cover two more questions on FIAC, and then I think most of the others were covered by your responses. Appreciate everyone staying on later, but we just have so many great questions. So any insights on what would trigger the retroactive concern for IP licensure payments?
There is a list of IP terms that would become problematic for existing licenses. Generally, they relate to things like how long the IP license is conveyed for and the level of control provided to the licensor over the licensee's production. So there's some statutorily provided provisions. I'd be for whoever that is. I'd be happy to like get into more detail with you if that's helpful. But there is some detail in the statute about that.
Okay, thank you, Abby. And then last, hopefully I'm understanding this question correctly, but it seems that this person's asking if they buy a facility that was previously owned by the daughter company of, I'm guessing this means with respect to the foreign entities of concern, are you still considered a successor? I'm not sure if I got that right.
Yeah, I probably don't have enough facts to be able to
Okay.
like answer that question concretely. So a good question to ask tax counsel.
Okay. Yes. And speaking of which, I probably should have said this outright at the top of the webinar, but please do not take any of this as official tax guidance. Even though we do have a couple of really fantastic experts on the call, please do consult your own accountants or attorneys before making any decisions. But we hope that this guidance is helpful to you and gives you a little bit better understanding of the legislation as well as what to expect in implementation. So I want to thank Lisa and Andy from the BCSE and CEBN teams for your assistance putting on today's webinar, and a huge thank you to Avi and Lynn for sharing your expertise with our audience.